Right now, the United States national debt is over 39 trillion and it's growing by billions every single day. For most people, that's just a scary number on the news. But for a group of traders on a platform called Kalshi, it's not just a number, it's a bet. They're putting real money on the line to guess exactly how high this debt will climb by the time the current administration leaves office. Take a look at this chart. When the market first opened, traders were pretty calm. They figured the debt would level off around 46 trillion. It was a boring, predictable path. But then the market went wild. Between late 2025 and January of this year, panic set in. The forecast shot straight up, hitting a massive 51 trillion. That's an extra 5 trillion in expected debt added in just 6 months. But then, in the last few weeks, the bottom fell out. The chart took a sharp vertical dive, crashing all the way back down to that original 46 trillion. A 5 trillion drop like that doesn't just happen by luck. It means something changed in how the country is spending money, or how people think it's going to spend money. Was it a change in the budget, a new tax plan, or was the whole thing just a bubble waiting to pop? In this video, we're going to map out the exact events that caused these massive swings. I'll show you the real world news that moved the needle, and by the end, I'll tell you exactly how you can use these numbers to make your own play. Let's look at how this all started. To understand why that 51 trillion spike was so crazy, we first need to look at how this market started. Back in early 2025, when the administration was just settling in, the mood on Wall Street was quiet. If you look at the first few months of this chart, you'll see a flat, boring line hovering right around 46 trillion. At this time, this was the consensus. Physical analysts, budget experts, and traders largely agreed the national debt was going to grow, but it was going to grow by a predictable, manageable amount. Think of this as the baseline. The market wasn't expecting any wild spending bills or major economic shocks. Traders were pricing in the standard, everyday reality of government operations. It's like a cruise ship on autopilot. You know the direction, and there's no sharp turns. But here's the thing about prediction markets. They don't stay boring forever. This 46 trillion baseline wasn't just a number. It was a trap. It assumed that the political environment will stay stable. But as we're about to see, stability is the first thing that goes out of the window when a major legislative debate hits the floor. Let's look at what happened when the autopilot was turned off. But by July 2025, everything changed. That steady, flat line on the chart, it started to climb. And it didn't just tick upward, it accelerated. Suddenly, the market wasn't looking at a 46 trillion debt ceiling anymore. Traders began pricing in something much bigger. The one big beautiful bill. This bill was a massive turning point for the US economy. It bundled together wide-range tax cut extensions, new tax breaks for workers, an aggressive increase in spending. When it passed in July 2025, it essentially signaled to the market that the era of budget restraint was over. Traders saw the sheer volume of new spending and the long-term costs of those tax cuts, and they immediately moved their bet higher. The market was now betting that all of this stimulus would force a national debt to balloon way past previous expectations. By January 2026, the sentiment hit a fever pitch. The forecast touched 51 trillion. At that moment, the market consensus was that the government was going to spend, spend, and spend with no end in sight. The belief was that tariff revenue simply wouldn't be enough to offset the massive cost of the one big beautiful bill and the funding for the new immigration enforcement agendas. It was a classic blow off top. When everyone is convinced that the numbers can only go up, the market often gets ahead of itself. The chart was screaming that the US was heading towards an uncontrollable physical future, but as we'll see in the next chapter, That uncontrolled feeling was about to run face first into a cold, hard reality check. Remember that vertical drop we saw on the chart in late April? That wasn't just a random squiggle. That was the moment the market had to swallow a hard truth. The hyper debt scenario just wasn't adding up. By the spring of 2026, the numbers started coming in. We saw the actual Treasury reports and the updated data from the Congressional Budget Office. The 12-month rolling deficit was sitting at about 1.7 trillion. High, yes, but not the 51 trillion disaster the market had priced in at the peak of the panic. So, why the sudden crash? Two big factors hit the tape. First, corporate tax collection in April actually held up better than the doomsday predictors expected. Second, the administration's focus shifted. With the ongoing conflict in the Middle East, the U.S. saw a surprising jump in petroleum exports, which helped narrow the trade deficit and provided a different kind of economic breathing room that traders hadn't accounted for. The market realized it had gotten ahead of itself. It was betting on a perfect storm of spending that didn't fully materialize. When reality didn't match the panic, the yes contracts for the 50 trillion levels were dumped, driving the forecast straight back down to that 46 trillion baseline. It's a perfect reminder in prediction markets, if the fear-driven narrative isn't backed by the incoming data, the correction is usually just as fast as the climb. So, where do we stand right now in June 2026? If you look at the board, the volatility has settled, but the market is still telling a very specific story. We're currently looking at three main price brackets that show you exactly what traders are betting on today. First, the 40 trillion ceiling, that's a 98% guarantee. The market is essentially saying it's a done deal. Then, the 45 trillion mark sits at 83%. That's a high confidence bet, meaning most people believe we are firmly on our way there. But look at the 50 trillion mark. It's sitting at 47%. That's your coin flip. It shows that the market is officially undecided on whether those big spending, high debt scenarios are truly dead or just dormant. This split tells us something crucial. The panic is gone, but the uncertainty remains. The big money hasn't fully walked away from the idea of high debt, but they aren't willing to bet the farm on it anymore. And that gap, that's where the opportunity is. So, how do you play this market? We have a 46 trillion baseline, but we also have the political wildcards for the next 3 years. Here's my strategic breakdown. If you're looking for a value play, look at that 45 trillion bracket at 83 cents. Mathematically, it's highly probable we clear that number just by inertia alone. It's a low yield but high confident bet. But if you're looking for asymmetric upside, the high reward play, keep your eyes on that 50 trillion bracket at 47 cents. If the next budget debate or tax bill shows even a hint of massive deficit expansion, that 40-cent price is going to jump. You don't have to hold it until 2029. You can catch the volatility and flip it for a profit. Remember, don't let the headlines dictate your entry. When you see a massive spike caused by a single news story, that's often when the market is at its most irrational. That's the time to hold back. You want to buy the fear, not the panic. I'm going to keep tracking these debt contracts as the next legislative cycle kicks off. If you want to stay ahead of these moves, hit that subscribe button. Drop a comment with your own debt predictions, and I'll see you in the next breakdown.